Thank you for watching NTD Business. Coming up tonight, gas prices are on the rise again. What's behind it and where is it going next? A farm group calling to investigate record high egg prices, saying price gouging could be to blame. California lawmakers proposing a new bill to tax the rich even after they've left the state. They say it's to reduce income inequality. And concerns about TikTok's data security grow as Senator Josh Hawley introduces a bill to ban the app nationwide. What could happen to the TikTok? That and much more coming up on NTD Business. Great to have you with us. Don Ma here. Prices at the pump are inching up once again as demand for gas rises. According to AAA, the national average price of gas is $3.48 a gallon. This is a 12-cent increase since last week. That's 38 cents higher than a month ago and 15 cents more than a year ago. The highest prices were in Hawaii, $4.94 a gallon, followed by California at $4.49 a gallon. A AAA spokesperson said oil hitting $80 a barrel has put a lot of upward pressure on the gas prices, and milder weather could also have something to do with it, with more Americans getting out and about after severe winter weather over the holidays and into the new year. And now joining me is GasBuddy's Patrick DeHaan. So Patrick, we're seeing gas prices on an upward trend for a month now. I want to ask you, what do you think are the factors that played into that?
Well, certainly quite a laundry list of factors going on right now. A lot of this stems back from the Arctic blast that hit much of the United States in late December. That had a profound impact on refinery operations. Some of those refinery operations were disrupted by extremely cold weather through much of the country. Shortly thereafter, China announced it was reopening its economy, and along with it, they've increased oil import quotas, which has pushed demand up globally. In addition, further sanctions on Russia by the EU are concerning the market that there may be tightness in supply, as well as an end to the SPR releases in the U.S. All of that pushing up oil, the wholesale price of gasoline as a result of oil going up and those refinery disruptions now pushing wholesale prices up 70 cents a gallon from a month ago, and that's playing out in rising retail prices.
So I'm glad you mentioned oil, because I've seen oil prices, ease a bit, and gasoline prices generally have followed oil prices. So I want to ask, where do you see gas prices going, let's say, in the next few weeks?
Well, certainly, given some of the upward pressure, really is contingent on where oil goes. Now, oil prices have come off their highs earlier this week. They're at about $80 a barrel, still about $8 higher than where they were a month or so ago. A lot of this is going to be contingent not only on the price of oil. As China reopens, we could see an increase in demand, but more so on turning that oil into things like gasoline, diesel, and jet fuel. And that ties back to those refineries. Now, utilization has picked up at U.S. refineries. It was at 92% in December. It fell all the way to 79% after the cold spell. We are now back at 86%, but we still need to see an uptick in refinery utilization to see gas prices moderate.
Yeah, and you said on Twitter, you can have all the oil in the world, but if there aren't enough refineries, gasoline prices could still be very high, right?
Yeah, that's exactly it. Highlighting the relationship between oil and gasoline. It's not always direct. You certainly could have oil be very cheap and gasoline very expensive if the bottleneck is refineries. And that's what we've seen from time and time again. We've been through a pandemic which saw 5% of refining capacity go offline permanently, and challenges with boosting production overseas. Some refinery expansions have been delayed, but there will be some improvement. Much of that is going to be overseas in Asia and Africa and the Middle East. But there is a U.S. refinery expansion coming online in the months ahead. But still, we are at a deficit to the amount of capacity we had just in 2019.
All right. Thank you very much for your insight, GasBuddy Patrick DeHaan. Pleasure talking to you.
Thank you.
Home prices across the country continue to drop as interest rates continue to rise. Goldman Sachs says the declines will continue through 2023, and 4 cities have the possibility of a home price crash. NTD's Sean Marshall has more.
Good and bad news predicted for home prices. The good news, the worst is over for the U.S. housing market, and prices will stop declining within 6 months, according to Goldman Sachs. But they also predict bad news, a housing crash in 4 cities: San Jose, Austin, Phoenix, and San Diego. So with this prediction of good and bad news, let's take a look at who could gain from a housing crash in those 4 markets and what's at stake for those who could lose out. Rena Cleota is a broker and founder of Pulse International Realty.
Who would gain from it? I mean, clearly the buyers, the buyers that have been waiting around. They've had a dual challenge with elevated mortgage rates and also the depletion of housing inventory. There has been, low inventory and high rates. And so that's really escalated prices to a place that's really not sustainable.
Goldman Sachs says overheated housing markets in the Southwest and Pacific Coast will likely grapple with peak-to-trough declines of over 25%, presenting localized risk of higher delinquencies for mortgages that originated in 2022 or late 2021.
What's at stake would probably be more on the investor side. The investors that already existing that had already purchased a bit high are now going to see a decline in their assets. They're not going to see the appreciation just yet, but it was par for the course.
KPMG chief economist Diane Swonk believes as much as a 20% drop in housing prices could be coming. Swonk connects her prediction to a slowdown in job growth in the tech sector. Thousands of layoffs at Facebook, Google, and Microsoft have hit the industry at similar times. She said hiring freezes in the tech sector are exacerbating declines. Many cheaper markets saw astonishing appreciation due to the higher salaries tech workers brought with them. Sean Marshall, NTD News.
But if you're in the market for a new home, don't be too optimistic about price drops. According to a new survey from NerdWallet, many American home shoppers are misinformed about the housing market. The personal finance company says home buyers are overconfident. On average, Americans hope to spend about $269,000 on a home. But the median home price is actually $100,000 more than that. According to the survey, many prospective buyers think prices will drop significantly because of a housing crash. Real estate economists say that likely won't happen this year. Last year, 70% of Americans who had planned to buy a home didn't succeed, either because their offers weren't accepted or because they couldn't find affordable homes. Americans are now paying more than double for a dozen eggs compared to a year ago. A nonprofit wants the government to see if there's a nefarious factor to blame, that is, price gouging. According to the organization called Farm Action, Mississippi-based Cal-Maine Foods saw a 600% increase in profits in the last quarter alone. Cal-Maine is America's largest egg producer. Farm Action claims industry leaders have colluded to take advantage of inflation and an avian flu outbreak for profit. The organization is urging the FTC to investigate and prosecute any egg producers who breach antitrust laws. On Wall Street, main indexes ended mixed today. The Dow rose 10 points, pretty much unchanged. S&P fell less than 1 point, also unchanged, and the Nasdaq lost 21 points, or 0.2%. California Democrats are pushing for a new tax on the state's wealthiest. That's going to include the ability to tax them even after they leave the state, or even after they move out of the country. State Assembly member Alex Lee introduced the bill last week. Here he is at a press conference this week calling for wealth taxes to, quote, bring tax justice.
For far too long, we've allowed income inequality to deepen and fester in this state and in this country where the rich get wealthier and the middle class shrinks and falls further behind.
The proposed law would tax the, quote, worldwide net worth of former residents who have moved abroad or to another state. It would impose a 1.5% tax on a net worth above $1 billion and 1% on any above $50 million. The new tax would generate about $22 billion per year, according to Assemblymember Alex Lee. That's roughly the same amount as California's budget deficit. California already taxes its wealthy residents more than most states, with the top 1% of earners accounting for around half of the state's income tax revenues. In response to the proposal, a local business group says it would drive even more wealthy residents to leave the state. A recent study found that more moving trucks left from California than from any other state in 2022 for the third year in a row, with the top destinations being North and South Carolina, Florida, and Texas. Other blue states have recently floated similar schemes to target the rich, including Connecticut, Hawaii, Illinois, Maryland, Minnesota, New York, and Washington. While each state has a different approach, they typically include taxing assets, lowering the threshold for estate taxes, and raising rates for higher earners. Senator Josh Hawley wants to stop lawmakers and their spouses from trading stocks. He introduced a bill yesterday to do just that. It's called the Pelosi Act. NTD's Daniel Monahan has more on the proposed legislation.
The Pelosi Act stands for Preventing Elected Leaders from Owning Securities and Investments. It would force members and their spouses to dispose of any holdings or put them in a blind trust. They would have to do so within 6 months of entering office. Here's Hawley on Fox News.
Members of Congress shouldn't be padding their own pockets and lining their own wallets. They ought to be focused on doing what the people sent them there to do.
Members found in violation would have to return their profits to American taxpayers.
I just think that is an invitation to all kinds of problems.
Last year, a story broke that Nancy Pelosi's husband, Paul, traded between $1 and $5 million of stocks for semiconductors. The trade came just days before Congress earmarked $52 million for the industry. On Fox News, Representative James Comer said that wasn't the first time Pelosi had done so.
He bought stock options ahead of all the big tech hearings.
Former House Speaker Nancy Pelosi has in the past defended her husband's transactions, saying he does not use information she's given to him. Paul Pelosi is not the only one. Former Senator Richard Burr sold investments after attending classified meetings on the COVID-19 pandemic. The SEC investigated that matter, but took no action against Burr. Senator John Ossoff, who introduced similar legislation in the past, spoke about the problem on Bloomberg.
We saw during the COVID-19 pandemic all of this stock trading by members around the same time as confidential briefings on the threat posed by the virus, trading in medical stocks.
Hawley's bill makes allowances for mutual funds, exchange-traded funds, and treasury bond purchases. The efforts to prevent government members from profiting from their public office has bipartisan support. Earlier this year, Hawley introduced a similar bill that would prohibit legislators from trading stocks while in office, while Democratic Senator Mark Kelly also introduced like-minded legislation last year. Daniel Monahan, NTD News.
Florida Senator Marco Rubio is taking aim at JPMorgan. In a letter to the bank's CEO, Jamie Dimon, Rubio denounced a partnership between America's biggest bank and TikTok's Chinese parent company, ByteDance. The bank is developing payments technology for ByteDance. Rubio's top concern involves the security of private U.S. user data. He cited the bank's efforts to help ByteDance with, quote, real-time data exchange, track and trace, and its ability to see and monitor payments. Under Chinese law, Chinese companies must hand over data to Beijing if authorities request it. But it's not just JPMorgan. Congress members are urging sports network ESPN to end a partnership with TikTok as well. While new legislation could pull federal funding to Texas colleges that refuse to ban TikTok on campus, Rubio demanded the CEO answer questions about the ByteDance partnership by mid-February. And as concerns about TikTok's data security grow, our special report today looks at what could happen to the popular social media app in the U.S. Right now, Congress is debating whether or not to ban the app nationwide. One way TikTok could save its U.S. operations is selling itself to an American company. This would potentially sever its ties to its Chinese parent company ByteDance, and it could ease concerns about the Chinese regime having access to its data. Republican Congressman Mike Gallagher is among those who have proposed a nationwide ban. And Gallagher says that if TikTok sells itself to an American company, this would be a workable solution. But would that really solve the problem? We spoke to tech researcher Jake Denton from the Heritage Foundation.
The realities of the internet, the realities of these kind of massive social media companies is that backdoors exist, that, a rogue employee within Microsoft or in any of these companies could potentially still grab the exact same data of targeted users and get it back to Beijing. And their inner knowledge of these platforms, right, the way that TikTok works, what they can collect, where it's stored, is going to pose a massive threat.
Denton says that potentially 2 years after a sale, we may find ourselves in the exact same situation. The CCP may still be able to look at our data. We spoke to Bob Bilbrook, founder of a tech consultancy firm and a tech investor, and he agrees. He tells us that selling to a U.S. company would not solve the problem.
They're still going to be attached to the Chinese government, and they're a Chinese-based company. So although that may appear, as far as market or Wall Street would be concerned, as a safe play, I don't think anybody would believe that for a second. As long as they are headquartered in China and their lifeblood is connected to the Chinese government like that, I think you're going to see, at least people like me in the tech industry that don't trust that.
Now, if TikTok is willing to sell itself, analysts believe a handful of contenders may be interested. Meta, Alphabet, Microsoft, Apple, even Elon Musk could all be in the running. So who exactly owns TikTok right now? American tech firm Oracle and Walmart both collectively own 20%. Chinese company ByteDance says it owns the other 80%, and ByteDance also runs the firm. If an outright sale isn't made and no middle ground is reached, then a nationwide ban could very well take effect. Attorney Michael Mandel says TikTok would have likely little recourse if it's banned on the grounds of national security.
I guess it would really depend on what the law, if it gets passed, says, and then TikTok would have to figure out how they can challenge that law in court. Right now, we're not at a point of knowing what the law is to see if it's something they can challenge. There are going to be concerns about First Amendment freedom of speech rights here, but there's going to be the counter argument that there's other platforms to express yourself. So it is something that we'll just kind of have to wait to see.
Meanwhile, Senator Josh Hawley was the most recent Republican to propose banning TikTok nationwide. He says TikTok is China's backdoor into Americans' lives. He says it threatens our children's privacy as well as their mental health. He plans on introducing new legislation to ban it, though he hasn't said when. And TikTok responded by calling Hawley's plan a piecemeal approach to national security. It says he should take a more holistic approach and accused him of pretending banning TikTok would make Americans safer. Gold prices rose to a 9-month high yesterday. This is amid fears of a global recession and also hopes of slower rate hikes from the Federal Reserve. Meanwhile, central banks set a new record of gold purchases in 2022, according to the World Gold Council. The world's central banks bought about 400 metric tons of gold in the third quarter last year. Purchases of gold have reached a level not seen since 1967. But why are central banks buying so much gold? A Mises Institute article explains that it's to protect their balance sheets. We talked to the author of the article for an in-depth explanation. And now joining me now is Daniel Lacalle to talk about why central banks are buying gold. So, Daniel, I was just reading your article on the Mises Institute site. So you talked about one reason why this is happening is because of a possible digital currency. Maybe just on this point, expand a little bit.
A lot of the central banks globally are now loss-making because they have been buying bonds and even ETFs or mortgage-backed securities that are losing money right now. So many of them are loss-making, and they need to purchase gold to prop up the balance sheet, to improve their reserve base, but also because the threat of a digital currency means that a lot of investment banks that used to treasure US dollars or euros are scared because with the introduction of digital currency, the risk of even decreasing the purchasing power of the currency even further than what it has happened in recent times is very high. So those central banks, particularly Asian, are looking at the risk of holding too many dollars and too many euros that could lose their purchasing power much more rapidly with the advent of a central bank digital currency. As such, they look to add more gold, which ultimately gives them a higher cushion and a better reserve of value.
And as well, you earlier you mentioned loss making. In your article, you said monetary devastation. Can you talk a little bit about that?
Well, think about this. Central banks have been purchasing extremely expensive bonds, sovereign bonds at negative yields, at negative real yields. They have been purchasing mortgage-backed securities at very elevated prices, and also in the case of Japan, for example, equity-traded funds. And in 2022, when the markets fell, all of those assets have lost massive amounts of value, and they're loss-making right now. So the balance sheet of the central bank is actually in need of a bailout. It needs to be recapitalized. And this is extremely dangerous in a moment in which, if they purchase more bonds and mortgage-backed securities, they would increase the problem that they have already incurred into. And if they continue being loss-making, confidence in the purchasing power, the currency, and the central bank itself may fall rapidly. So it's a very challenging situation for most of the developed countries' central banks.
Essentially, what it all comes down to is the stability in the value of gold. Would you say that's correct?
Yeah, absolutely. If you think about it, the gold is the only decorrelated asset and one that has proven to be a reserve of value for centuries. So for many decades, central banks have reduced the percentage of gold in their asset base and increased the percentage of equities, bonds in the so-called quantitative easing period. But with the collapse of markets, especially bonds and equities at the same time in 2022, what has happened is that the fragility of those assets and the fragility of the asset base of central banks has come to the fore. This is very evident right now. And as I said before, they're loss-making. So gold ultimately is proving to be the stability factor that many central banks require.
And just one last thing, in light of central banks, buying gold, where do you see gold prices going?
Well, obviously, the first element that is positive for gold is the supply and demand scenario. Supply is extremely tight and demand is rising globally. Now, the second one is obviously its value as a reserve. Globally, everybody understands, and we saw it in 2022, that the price of gold is very stable, even in periods of very aggressive moves in markets. The third one is obviously the fact that central banks are starting to buy more gold in order to keep their balance sheets relatively safe and relatively stable. So those three elements, higher the tightness of supply-demand, plus the component of reserve of value in a period of recession or stagflation, which is the risk right now, added to the need from some central banks to diversify out of the euro in particular, but also the US dollar, is propping up gold demand. So I think that the likelihood of its price continuing to rise is quite significant also because it's an asset that is very underweight in the investor portfolios. Investors tend to be extremely overweight equities or bonds or both, and have very little exposure to precious metals. So I think that is another reason, is that the financial world needs to catch up to at least be equal weighted.
All right. Thank you for your insight today, Daniel Lacalle, Tresses Hedge Fund. Great having you on.
Thank you so much.
And that's the latest from the NTD Business team and myself, Don Ma. You can follow me on Twitter if you're there. And if you have any news tips or feedback for the show, please email us at business@ntd.com. That's all for today. Thank you for watching. I'll see you tomorrow.